on Yahoo Finance Presents is Bill Gross. Bill, good to get some time with you. It's just, I don't even know where to begin this conversation with you, but let's start on the topic du jour of today, recession. How concerned are you about a recession in this country, and what does that mean for markets?
Well, I am concerned, unlike Chairman Powell. A flat yield curve, historically at least, has portended slow growth or recessionary conditions, and that's what we have now. In some cases, we have a 5-year higher than a 10-year in terms of the Treasury curve. So that's one thought, I guess. And the other thought would be that inflation as it is and oil prices as they are, basically sap consumer purchasing power, and much of that, or some of that at least, in terms of the COVID relief has evaporated and disappeared. So, there are a lot of questions going forward related to, obviously, to the Ukraine and to China and their situation with COVID. But I think we're definitely at a slowdown. The Atlanta GDP forecast basically shows a flat quarter going forward. And so I think we're at the zero line, and maybe at some point we go below that.
How does the Fed address this? If they move too fast, they can risk pushing us into recession. At the same time, we're seeing inflation hover around double digits. They are really up against it.
They really are. And the question becomes for them and for the market, what is the neutral interest rate, the neutral short-term interest rate, and indeed a neutral 5 and a 10-year Treasury. So, it's almost unanswerable based on inflation where it is and where it might be going over the next year or two. Powell has suggested he goes in pretty big steps for the next 12 months. And where does that take us in terms of the Fed funds level? Maybe at 2% plus or minus. But the real question is that still stimulative or is it not stimulative? And I don't think they have the answer. They sort of have a policy of, we'll see how it goes. And I think the market has to do that too. But there's certainly an interest rate that can break the market, like in 2007 and 2008, because mortgage rates are basically not variable focused. They're long-term entrenched. And so, homeowners won't be hurt like they were back then, but there's certainly an interest rate, a 10-year, let's call it, at 245, that if it goes higher than 3%, in my opinion, will certainly slow down the economy and maybe produce a recession.
For someone who hasn't seen as many cycles as you, I'm not calling you old. I'm just saying you've seen a lot of different cycles, investment cycles. What do you think about folks calling for a potential 6 to 7 rate hikes this year? To me, that sure seems like a lot, yet the equities market continues to shrug this off.
Well, it is a lot, but the continuing question is it still stimulative at levels of 1.5 to 2%? And so we'll have to see. In my opinion, the equity market, the bull market, that perhaps still continues, although it may be seen its last legs, was driven by lower interest rates over the past 10 years, certainly, and even over the past 20 to 30. And so when we hit rock bottom in terms of, at least in terms of Fed funds, and when we had QE that sort of took rates in a negative category, then, a lot of that, and I would say 30% of that was due to lower interest rates. So now that we've reversed, I think it's definitely a headwind as opposed to a tailwind.
What would you compare this time period to? Is this back to that Paul Volcker type era, or you see it somewhat different?
No, we can never do, in my opinion, what Volcker did, and I have a lot of admiration for Volcker. He was the mensch of basically the Fed for the last century, but certainly a 20% prime can't exist in this world, even with 7 to 8% inflation. And the reason it can't is that there's there's certainly a lot of leverage in the system. Some of it's hidden, but a lot of leverage. And to the extent that that leverage is dependent upon cheap short rates, then raising Fed funds to 3, 4, 5, 6 is certainly going to break the financial levered market, and that leads to negative consequences everywhere else.
I caught a quote from you recently. You mentioned that the Fed could crack the economy. Would a cracked economy, is that a recessionary economy?
I think so. Yeah, and crack's a very harsh word. It tends to suggest 2008 and 2009. And I don't think we're headed for a great recession, because I think Powell knows, even though when Powell came onto the Fed, he was pretty much of a hawk as opposed to a dove. I think Powell knows that he can't go that far, but for the moment, it's not cheap. Talk is influential, and he's talking tough. I don't think he can go much higher than 3%.
Is this a stagflationary environment?
Certainly. The question is how much of the inflation exists with the stag, and I don't think 7 to 8% inflation or more, which we have now, is really in our future. A lot of things will reverse. Housing prices, oil prices, et cetera, used car prices. And so I think we're looking at 4 to 5% inflation for the next several years. So that's stagflation, but it's not the stagflation of the early 80s that Volcker had to contend with.
One of the hallmarks of the past decade of investing is that double-digit returns have been the norm, but now we're going into a tightening cycle. And what do you think the next decade has in store?
Well, I don't think double digits, but to be fair, I've said that for a while, and we certainly have had double digits. We've had expanded PEs, lower interest rates that have driven them. I just think that if interest rates are reversing, and they're not just doing that in the US, they're doing that in Germany, they're doing that in Australia, the UK, et cetera, et cetera. So it's a global reversal of sorts. I just don't think that interest rates are the tailwind that have provided those double-digit returns, and that certainly if we have a recession or close to a recession, the earnings themselves will be, stagnant.
If we were having this conversation 15 years ago, I don't think we would be talking about something called meme stocks. Did I have this right, that you've been betting against AMC and GameStop? How have you done this? Why have you done it? And curious.
I have, and it's not a good day, is it? It hasn't been a good week. I simply think that AMC and GameStop are lottery tickets. It's not that people don't win lotteries, and certainly the apes that, as they call themselves, that are behind us have their day, and so let's have them have their day. But the real valuation here is a question of volatility, and the volatility on AMC and GameStop is 120 or so. And if you can sell, not buy options, if you can sell options at out of the money levels, then ultimately, these lottery ticket companies, which have very little behind them, in my opinion, will go down. So we'll see, but I'm not having a nice day.
Is someone that built PIMCO from the ground floor, one of the most noted investors out there the past 30 years or so, are you surprised by the influence the next generation of retail investors have had on this market the past 2 years?
Well, I guess in retrospect, we shouldn't be surprised, because young people have known nothing but success in terms of bull markets. I think the stocks go up, you always want to buy the dips, et cetera, et cetera, et cetera. And so, it's hard to go against momentum, and it's hard to go against the crowd, because it's the crowd that determines direction and upward momentum if we're in a bull market. So I would say, yes, it is different. Will young people, millenniums, will they ever become more negative and bearish? it'll take some time. They simply think that stocks go up, that double digits are what they deserve, and we shall see.
I enjoyed reading your new book, I'm Still Standing. What's the biggest thing you want to clear up about your track record in your career and what you ultimately corrected or created at PIMCO?
Well, my track record, even up until 2014, there was talk, there's been writing about how it was underperforming. It wasn't, and I was willing in my book to put forward a proof page for that, but my lawyers counseled against it. But so I simply think that it was a nasty type of exit. The scars have healed, I think, on my part, but the scars were red and now they're white. But I still have negative recollections of how it was handled on their part.
Two more before I let you go. You always learn a lot, I imagine, as you're writing a book or you're just writing anything about yourself in general. What did you learn about yourself going through this book process?
Well, I wrote a book 25 years ago, and but not that I can recall much about it. I learned that the situation on both sides, to be fair for PIMCO and to be fair to me, it's a subjective type of assessment, and I was willing, at least on my part, to address what they had thought in terms of firing me in 2014, and I wasn't willing to accept that, but I was willing to temper my anger, I guess, in terms of what had happened, and so that's good. Time, like I said, doesn't heal all wounds, but I learned that there are two sides to a story.
And lastly, as someone who has spent many years reading your investment outlooks, watching you in various outlets, what do you think your legacy is in the financial services industry?
Well, I think it is with PIMCO, and PIMCO is a team. It just wasn't a bond king, but the legacy of PIMCO and myself as the leader, I think, was that bonds can have a total return, not just a coupon and not just an interest payment, but a total return if conditions are appropriate. And the fact is that ever since 82, 83, bonds have been in a good bull market, and total return, which is the concept that I devised, was a winning type of strategy. Going forward, total return, if it implies higher bond prices, is a difficult concept to embrace, but at least it allowed the investment world to know that bonds weren't just something that went into the vault and you clipped a coupon every 3 to 6 months.
Well, I will say this real quickly. Keep those investment outlooks coming. I do enjoy reading them every few weeks when they are posted. Bill Gross, good to get some time with you. Stay safe. We'll talk to you soon.
Thank you, Brian.